not only the price target, but we downgraded the stock from strong buy to hold. And we think going forward, they're going to be a market performer at best. All three banks are diversified banks. Unlike JP Morgan, Bank of America is not executing in all businesses. And clearly, we would look to the weakness in investment banking and trading. Commercial lending, not that great. The strong area is consumer and also efficiency or cost cutting, but that's going to level off. So we think Bank of America is a hold. JP Morgan's just doing a much better job.
Let's talk about Citigroup, where you recently raised the price target to 75 by $2. Not huge, but significant enough.
We did, and JP Morgan is a buy. Citi is a hold as well. And the profile of Citigroup is very different than JP Morgan and Bank of America. It's more of a global play. They have much more exposure to the emerging markets, Mexico, Southeast Asia for consumer and commercial lending. Generally, what we like to see is a large percentage coming out of the U.S. footprint, 50%, which is JP Morgan and Bank of America, and Europe. So with Citi, you're always playing that risk related to the emerging markets. They're doing a pretty good job, but JP Morgan and Bank of America are expanding strategically with new financial centers and bank branches. Hard to believe, but it's true.
Ken, just zeroing in on Bank of America, how concerning to you is the loan growth number? I mean, it was decline in balances across the board when you take a look at home equity, credit, U.S. commercial, direct and indirect consumer. I mean, what are they doing wrong? Are they losing share to another bank, or is loan growth overall for the sector in jeopardy?
Yeah, the key drivers are definitely consumer loans as well as credit cards, which generate loans. The weak areas that are declining is home mortgages and then also auto loans. So I don't think it's any one thing. It's just they don't have the strong franchises that JP Morgan has or Citigroup in credit card.
Looking out to 2019, Ken, I mean, do you expect that the performance of the banks will finally catch up? I mean, theoretically, we are in an economic environment which should be completely beneficial to the banks and should see the shares rise, and yet they have been a disappointer this whole entire year. It's been a very tough trade for bank bulls.
Absolutely. Investor sentiment is negative. Will's comments about the high net interest income, that will continue with the Fed increasing 3 or 4 more times. But the concern really is, why aren't these banks generating higher loan growth in a strong U.S. economy? The corporates perhaps are flush with cash after tax reform, but that's the big challenge. Clearly there's runway as it relates to rising interest rates, but we have to see more generation of loans.
Quick thought on what has been for some years now the problem child among the big banks, and that's Wells Fargo. Quick thought.
We have a sell recommendation. There's brand damage. There's changes in management at the middle levels. They actually had a pretty good quarter on operating leverage. And also the one positive to keep Wells Fargo decent is the Fed approved a significant capital return along with the other banks. But I think Wells, this is not a 1 or 2 quarter turn. It's going to take time. They'll get it right. It's just not going to be in the next 6 months.